Billions were wiped off the value of U.S. lenders last night as aftershocks from the collapse of Silicon Valley Bank continued to rattle the markets. State Street, one of America's oldest banks, saw its share prices tumble after revealing that clients had pulled tens of billions of dollars at the start of the year. Customers withdrew $26 billion from State Street's investment products in the first quarter. Shares in the Boston-based company fell as much as 18%, its worst intraday tumble since the early days of the pandemic in 2020. Meanwhile, stockbroker Charles Schwab said $41 billion had been pulled from its accounts during the first 3 months of 2023. The company blamed regulatory uncertainty following the collapse of SVB in March and the emergency rescue of Credit Suisse in Europe shortly thereafter. Schwab's results also revealed it had bolstered its finances by borrowing $45.6 billion from the Federal Home Loan Bank system, a move sometimes viewed as a sign of financial stress. Chief Executive Walt Bettinger played down recent instability, telling investors, "As storms come, storms also go." Shares in the broker, which are down by more than a third so far this year, initially dipped in New York before climbing 3 points. News of the withdrawals sparked concerns at other U.S. banks. Northern Trust was down 6% and BNY Mellon fell 7 points. The downbeat figures fueled fears that the U.S. financial system could experience further turbulence in the wake of the worst banking crisis since 2008. Jane Fraser, chief executive of Citigroup, last week warned that the U.S. will fall into recession this year, while J.P. Morgan boss Jamie Dimon said there were storm clouds gathering in the wake of the recent banking crisis. Regulators around the world are considering tightening the rules in light of the recent rapid bank run that brought down SVB. Chancellor Jeremy Hunt and Bank of England Governor Andrew Bailey are both assessing whether to extend government guarantees on bank deposits in order to give customers more confidence that their money is safe. Deposits of up to £85,000 are covered in Britain today. Mr. Bailey is understood to be open to increasing that ceiling to limit the impact of social media-fueled bank runs. Andrew Griffith, Economic Secretary to the Treasury, said he and his officials were working with the bank to constantly look at whether you've got the right threshold and the right scope. John Vickers, the economist who helped to draw up Britain's financial regulation in the wake of the 2008 crisis, said banks should be forced to hold more cash if government guarantees were increased. He told Bloomberg, "If the state is more on the hook, the quid pro quo is that there has to be a lower risk of insolvency, and the only sure way of achieving that is more common equity capital." Instability for U.S. bank stocks came at the start of a busy week for earnings in the sector. Several regional banks are scheduled to update on how they have fared so far this year, with concern over how serious the fallout from SVB may have been for smaller lenders. J.P. Morgan and Citigroup last week delivered better than expected figures, in part thanks to an influx of deposits from customers fleeing smaller institutions. But that said, a bleak outlook and fear of the overall market still looms. With rising tensions with China and Russia, added with additional strain with a possible conflict with Taiwan, as well as a possible civil war developing in Sudan, leaving hundreds dead and hundreds more wounded, investors seek to find stability in an otherwise unstable market. Negative global events are sending ripple effects in the overall market. Which of these catalysts may fuel another banking collapse or even worse, accelerate an already pending recession?